Something just shifted in Japan, and almost nobody is paying attention. 3 officials at the Bank of Japan just pushed for a rate hike, and within minutes, the yen surged, and Bitcoin started falling. But here's what should really worry you. This exact setup has triggered violent market moves before, and it's tied to a hidden $1.2 trillion trade that could unwind fast. If that happens, Bitcoin won't just dip, it could cascade. The Bank of Japan held one of the most closely watched policy meetings in recent memory, and here's what came out of it. A 6-3 split vote. 6 members wanted to hold, 3 wanted to hike. And the market is now pricing in a 74% chance of a rate hike in June of 2026. 74%. And almost immediately after that meeting, we saw the yen start to strengthen and Bitcoin start to pull back. Now, you might be thinking, okay, what does Japan have to do with Bitcoin? These things seem completely disconnected, and that's exactly why most people get caught off guard when this stuff moves markets. So before we go any further, quick note. Nothing in this video is financial advice. I'm breaking down macro data and market dynamics, and you should always do your own research. But this is the kind of context you need to understand before making any decisions. Stay with me until minute 17, because what I'm about to show you fundamentally changes the way you see Bitcoin's relationship with global liquidity. This wasn't just another central bank meeting. This was a signal that something deeper is starting to shift. And here's the question I want to leave open in your mind right now as we go deeper into this. What if this isn't really about Japan at all, but about a global financial system that is quietly starting to crack? That's what we're going to explore today. Morning, afternoon, or night? For you right now. Drop it in the comments. I'm always curious who's watching and from where. All right, let's build the foundation here, because if you don't understand this piece, nothing else in this video will make sense. Japan has had ultra-low interest rates for a very, very long time. We're talking about decades of near zero or even negative interest rates. While the rest of the world was raising rates to fight inflation, Japan was essentially keeping money free. Almost free. The cost of borrowing yen was practically nothing. Now think about what that does to a global financial system. When you can borrow money in one currency at almost no cost and then deploy that money somewhere else with a higher yield, you do it. Institutional investors, hedge funds, banks, they figured this out a long time ago. You borrow in yen, you convert those yen into dollars or euros or any other currency. You invest in higher yielding assets, US Treasuries, stocks, real estate, emerging markets, and yes, crypto. You collect the spread. And for years, this is exactly what happened. Japan became the world's funding engine. For years, money has quietly flowed out of Japan into global markets, including crypto. Now, here's the part nobody explains clearly. This wasn't just a little bit of money. This wasn't a niche financial strategy used by a handful of hedge funds in Tokyo. We're talking about a system so large, so deeply embedded in global capital flows, that when it moves, everything moves with it. The scale of this thing is almost hard to believe until you see the numbers. And if that flow reverses, everything changes. That's the loop I want you to hold on to. We'll come back to it. But first, let me show you just how big this trade actually is. Here's where it gets serious. Japan currently holds approximately $1.24 trillion in US Treasuries. $1.24 trillion. Let that number sit for a second. That makes Japan the single largest foreign holder of US government debt. Larger than China, larger than the UK, larger than anyone. And it wasn't a one-time purchase. It wasn't accumulated over some ancient period of history that doesn't matter anymore. In 13 of the last 14 months, Japan has been actively buying US Treasuries. 13 out of 14. This is a continuous, sustained, deliberate capital flow from Japan into US dollar-denominated assets. This isn't small money. This is one of the largest capital flows on the planet, and it's been flowing in one direction. Now, let me explain how the carry trade actually works, because this is the engine that drives all of it. The basic mechanic is straightforward. You borrow yen at a very low interest rate, let's say near zero. You then take those yen and convert them into US dollars. You use those dollars to buy a US Treasury bond that pays you, say, 4 or 5%. You pocket the difference, you repeat it, you scale it. You do this across trillions of dollars of capital. This is the yen carry trade. And for many years, it worked beautifully because interest rates in Japan stayed low while rates elsewhere stayed higher. But here's what makes this trade dangerous. It only works as long as the yen stays weak. The moment the yen starts strengthening, the dynamics flip. Your yen-denominated debt becomes more expensive to repay. Your dollar-denominated returns look smaller in yen terms. The profit margin compresses. And if the yen moves fast enough, the whole trade stops making sense, and you have to unwind it. You have to sell the assets you bought with those borrowed yen and buy yen back to repay the loan. When that kind of money moves, markets don't adjust slowly, they snap. And that is the mechanism we need to watch right now. hit, like if this is starting to make sense, I want to know this content is landing the way it should. So now let's connect the next set of dots. The Bank of Japan held rates near zero for decades, but starting in 2023 and continuing into 2024 and 2025, they began slowly, cautiously moving rates higher. And the market has now priced in another hike coming in June of 2026. Here's what happens when that expectation builds. When investors believe that Japanese interest rates are going up, they start buying yen, because a currency backed by higher interest rates is more attractive. Capital flows toward yield. It's a basic principle of global finance. So as rate hike expectations rise, the yen strengthens. And when the yen strengthens, the economics of the carry trade deteriorate. Borrowing yen is no longer cheap in the way it was. The cost of maintaining those positions goes up. The margin gets thinner. And the risk of being caught holding a trade that's moving against you gets real. Now, here's what most people are missing. The same trade that pushed markets up can pull them down just as fast. When carry trade positions unwind, the selling isn't contained to one asset class. It's not like investors say, okay, we'll sell some bonds, but keep our crypto. When a carry trade unwinds, everything gets sold. Equities get hit. Emerging markets get hit. Risk assets across the board feel the pressure. And crypto, being one of the highest beta risk assets in existence, feels it acutely. This is the linkage. This is the connection between a decision made in Tokyo by 9 central bank board members and the Bitcoin price on your screen. And we've already seen what happens when this unwinds. That's the loop I promised to close. Let's do it now. August of 2024. If you were watching markets that summer, you remember it. If you weren't paying close attention, here's what happened. In late July and early August of 2024, the Bank of Japan surprised markets with a rate hike. It was relatively small in absolute terms, but the signal it sent was enormous. The yen, which had been weakening for months, began to reverse sharply, and within days, we watched one of the fastest carry trade unwinds in recent memory. Global equity markets sold off hard. Japanese stocks had their worst single-day decline in decades, and Bitcoin, which had been trading around $65,000, dropped to roughly $50,000 in under a week. That is a 23% drawdown in less than 7 days. That drop didn't come out of nowhere. It wasn't driven by any news in crypto. It wasn't Binance. It wasn't a regulatory crackdown. It wasn't a technical breakdown. It was liquidity getting pulled. Global liquidity, sourced from the carry trade, unwinding simultaneously across risk assets. Bitcoin was just caught in the blast radius. Now here's the part that should concern you. That episode in August 2024, it happened off a relatively modest and partially anticipated rate move. Markets were somewhat prepared for it, and it still hit Bitcoin for over 20%. And this time, the setup could be even bigger, because the cumulative carry trade positions that have been built up are larger. The yen has been weaker for longer, and the potential snap, if it comes, has more potential energy behind it. What would you do if this actually plays out? Comment below. I genuinely want to hear how you're thinking about positioning. Now here's what most people are not paying attention to, and this is where things can break in ways that are hard to predict. The carry trade pressure from Japan isn't happening in isolation. We're simultaneously navigating a global geopolitical environment that has shifted dramatically. The Strait of Hormuz, one of the most critical shipping choke points on the planet, has faced ongoing disruption risks tied to tensions in the Middle East. Roughly 20 to 25% of global oil flows through that strait. Any sustained disruption to that flow creates immediate energy price spikes. And here's why that matters directly for Japan. Japan is not an energy-producing nation. Japan imports nearly all of its energy. When oil and gas prices rise globally, Japan feels it more acutely than almost any other developed economy. That creates domestic inflation pressure. And domestic inflation pressure creates pressure on the Bank of Japan to act. Think about what that means for the timeline. The 6-3 split at the last BOJ meeting. 3 members already wanted to hike. That's a significant dissent. The majority held, but the margin is narrowing. And if we get a sustained energy shock layered on top of already elevated inflation expectations, the calculus inside the Bank of Japan shifts quickly. This isn't just policy, this is pressure. The BOJ isn't hiking rates because they want to slow the economy. They're hiking because they may have no choice. They are being pushed by forces they don't fully control. Global energy markets, domestic cost of living, currency dynamics, and external pressure from allies who don't want Japan to keep flooding the world with cheap yen. And when central banks are forced to act, they don't always control what happens next. That's the danger here. It's not a deliberate, controlled, telegraphed policy shift. It's a central bank being pushed by circumstances into a corner, making moves that can cascade through global markets in ways that are very difficult to predict. This is exactly why this matters right now. Share this with someone in your network who's in the markets, because this is the kind of context that most financial commentary completely ignores. All right, now I'm going to do something that most people in financial content don't do. I'm going to show you the other side of this argument. Because here's the thing about complex macro situations. They're almost never as clean as the bearish case makes them sound. Here's what the data also shows. Japan is still buying US Treasuries in 13 of the last 14 months. They haven't stopped. They haven't reversed. The capital flow is still going in the same direction it's been going for years. The carry trade is still active. There are still massive pools of capital borrowing in yen and deploying into dollar-denominated assets. The trade hasn't unwound. Most of those positions are still open. And the Bank of Japan is still moving slowly. They hiked rates from near zero to a range of around 0.5% over the past couple of years. By global standards, that is still essentially zero. The interest rate differential between Japan and the US remains large. The basic economics of the carry trade are still intact. So here's the twist. The system hasn't broken yet. Japan's sovereign wealth and institutional capital continue to flow outward. The yen carry trade, while under pressure, is not in full reverse. And Bitcoin, despite the volatility, is still sitting significantly higher than it was 3 years ago. But that's exactly what makes this moment dangerous. Think about what a pressure system looks like before it releases. The more it holds, the more energy builds behind it. The carry trade is like a coiled spring right now. The positions are large. The sensitivity to yen moves is high, and the market knows it. When everyone knows a spring is coiled, they all have their finger on the trigger to move first. And in markets, the fear of a cascade can itself become the cascade. This is where smart money is already moving. Not necessarily out of positions, but into hedges, into protection, into structures that don't rely on everything staying calm. Do you think the system can hold? Leave your answer below. I want to see what the community is thinking. Let's build out the full scenario. It's June of 2026. The Bank of Japan, facing stubborn domestic inflation and continued pressure from a weak yen, raises rates by another 25 basis points. It's the move that the market had a 74% chance priced in for. What happens next? The yen spikes. It moves fast. Faster than most traders can react, because the move had been anticipated, but the timing was uncertain and positions were held anyway. As the yen strengthens, leveraged carry trade positions start to bleed. The margin calls start hitting. Institutional players who built these positions over months or years don't have the luxury of waiting. They sell, not slowly, not in an orderly fashion. They liquidate. US Treasuries start getting sold. Global equities feel the pressure as dollar liquidity tightens. And risk assets, the ones at the highest end of the risk spectrum, get hit the hardest. That means crypto. Bitcoin, Ethereum, and the broader digital asset market absorb some of the most concentrated selling pressure in this scenario. Not because of anything specific to crypto, not because of a hack or a regulatory ban or a founder scandal. Simply because of where it sits on the risk curve. Markets don't wait for confirmation. They react to expectations. And right now, expectations are shifting fast. Here's the additional layer that makes this more acute than previous cycles. The global macro environment is not supportive in the way it was in 2022 or 2023. Interest rates globally are still elevated. The Federal Reserve is not in an aggressive easing cycle. There is no obvious monetary backstop waiting to absorb a liquidity shock. If the carry trade unwinds in 2026 and there's no Fed pivot to cushion it, the drawdown in risk assets could be sharper and longer than what we saw in August of 2024. That is the fear scenario, and it is not a fantasy. It is a plausible path, given the data we can see right now. Are you positioned or just watching? That's an honest question worth sitting with. All right, let's flip the frame, because this story doesn't end in darkness. Here's what history actually shows us. Every major liquidity shock in the modern era, every sharp, sudden contraction in global risk appetite, has ultimately been followed by a policy response. Central banks around the world have one fundamental instinct when faced with a financial crisis: print, intervene, inject liquidity, stabilize the system. The Federal Reserve did it in 2008. The Bank of Japan did it through decades of quantitative easing. The European Central Bank did it with its whatever-it-takes moment. Every major central bank on the planet has demonstrated, repeatedly, that when faced with a genuine systemic shock, they choose expansion over contraction. And what has happened to Bitcoin every single time global monetary policy has shifted toward expansion? It has moved. Hard. Every liquidity shock in history has eventually led to more intervention, more printing, and stronger moves in Bitcoin. The short-term pain of a carry trade unwind, if it comes, is a temporary compression of liquidity. A forced selling event, an ugly couple of weeks or months where everything goes down together. But the monetary response to that shock? That's where the long-term Bitcoin thesis gets even stronger. Because the response to a carry trade unwind, to a global liquidity crisis, to a financial market panic, is more yen, more dollars, more euros, more central bank intervention. More of the exact thing that Bitcoin was designed to exist as an alternative to. So here's how to hold both of these truths at the same time. Short term, there is real risk here. The setup is live. The 6-to-3 split is real. The 74% hike probability is real. The 1.24 trillion is real. If this unwinds, Bitcoin will feel it. But long term, the system responding to that unwind is bullish for Bitcoin in ways that compound over years. This could be pressure, or it could be preparation. The question is whether you understand what's coming before the headlines do. If you've been watching for a while and this finally made the picture click, do me a favor. Drop the word signal in the comments. I'm tracking which topics resonate most deeply, and that tells me exactly where to go deeper next. Let me bring this all the way home. The Bank of Japan, 6-to-3 split, 74% probability of a June hike, $1.24 trillion in US Treasuries, accumulated through 13 of the last 14 months. A yen carry trade that has been the quiet funding engine of global markets for decades. Geopolitical pressure through energy inflation, forcing the Bank of Japan's hand. A historical precedent, August 2024, where Bitcoin dropped from 65,000 to 50,000 in under a week when this exact mechanism triggered. In a current setup that is, by multiple measures, larger and more loaded than it was then. This isn't just about a rate hike in Japan. It's about a $1.2 trillion system that could start moving. And if it does, Bitcoin won't be the last thing to react. It will just be the first warning. The window between understanding something like this and the moment the crowd understands it too. That window is where the opportunity lives. And right now, that window is open. If you want to stay ahead of moves like this before they hit the headlines, subscribe now. Hit the notification bell so you don't miss the follow-up on this, because the next data point that comes out of Japan could change the probability on everything we discussed today. And share this video with one person in your life who's serious about their financial future. Not someone who needs convincing, someone who's already paying attention, because by the time everyone understands what we just walked through, the move will already be over. I'll see you in the next one.